It is Sunday, January 14th, 2018. Weekend recap, Dow Jones Industrial 30s Index. Okay, so Friday we had another positive session on the Dow. We closed up, I think, by memory, 230 points. If we look on the viewing the daily chart, the standard chart, the normal trading, which is the normal trading hours for the Dow, we can see it's created a gap from the previous day of Thursday, January the 11th, quite a sizable gap too. So where will this head? I believe it's public holiday on Monday in the US, so the markets will be closed. But when they come back on Tuesday, where will this may move? Given that it's going to open outside the top Bollinger Band and it's left a gap. If we look back and view what happened last time when that happened, even though we had the squeeze on the Bollinger Band, but when the candles jumped outside of it and created a gap there, we had this long candle which wicked right down to close the gap. And then we had actually a few days where it pulled back in. So I believe initially, depending on what news comes and what happens in the bond markets and the US dollar, I believe that even if it's positive, we're going to see a pullback, and it may want to close, or once it pulls back, it will probably look to possibly close this gap. We'll have to wait and see. It's interesting that other markets on these turning points obey them and have corrective sell-offs, excluding the Dow Jones, which just really sums up the complete euphoric state of this market, the irrational exuberance, even with negative news. And given bond markets during last week was sold off quite heavily too, that's people that know that if you want to ultimately know where the Dow Jones, the S&P and the Nasdaq's going to head, it always starts in the bond market, and it's sending a warning sign when bond markets are selling off and you have the shorter end of the curve, which is the 2-year bond yield going up over 2%. Now you compare that with the S&P 500, where the overall yield of the S&P 500 is 1.8%. So a 2-year treasury note, a bond yield, is paying more than the S&P now. So that's just one thing to keep in mind. But who knows? As I stated in my last forecast with the Dow Jones, that we're in the final phase of a blow-off top. So the irrational exuberance, this still may have another 1,000 points in it. If we just pull that down, if we go to this chart here, this other chart, this monthly chart, we have this very important Gann timing angle, which is measured, of all things, lunar lutations of the moon and other important cycle points, which I covered in my presentation, Tunnel Through the Air 2018. So even though we've momentarily gone above this, I think we're going to pull below this, and just interesting to see if this Gann angle is going to hold and maybe mark in a market top. We'll have to wait and see. But given given this move in this late stage of this bull market is near parabolic compared to the other measured moves, I really can't see this going much further. But as some of you have asked me, do you go short at this present time? As I've said, it's still too risky to take a short position. I wouldn't be going long. I wouldn't be chasing this. And my advice and my opinion on the Dow Jones and the S&P and the Nasdaq is we need to see a proper reversal capitulation of these indexes where we get a maybe 500-600 point wipeout, which will really signal that we're going to see a correction or something, or even possibly a crash, which I think will come this year. So until we start to see those cycles, and we can always, if we go to daily, we'll know by using moving averages. If I just open this one for a second, once the price action on the daily starts to break below the moving averages and the moving averages start to roll over and point down, we're definitely getting signals of a bigger or a market crash is coming. So until that happens, we have to. My best view is to still stay on the sidelines with this. There's better markets to trade, but we still have to see, because this will, at some point, this will present a good trade, but not at this point in time.